Hello, welcome back. I am taking a look at the market news module here in our tool, and you will notice a lot of discussions about Salesforce, why Salesforce stock is rising today. Another one here, Salesforce shares are not expensive. Well, we'll see about this one. So let's take a little bit of a closer look at what happened. You will first of all see in our stock analysis chart here that the stock is actually up 10% pre-market. That is, in about half an hour the market opens in the US, so we'll see what's going to happen. Maybe it's going to shoot up even higher. This is a $160 billion company, and it's been down about 50% from its one-year high, so it's been down a lot. Now it looks like it's gaining back some ground. We're going to examine the financials, but first of all, let's take a look at what happened in the earnings report. So stock jumps as it raises profit forecast, and of course the Wall Street loves this one. CFO says company will be more measured in hiring. Now, what happened here? Earnings, 98 cents per share, that's adjusted, versus 94 cents per share, so a little bit worse than expected here. Revenue, 7.41 versus 7.38, that's a little bit better. Now, Salesforce revenue rose 24% year over year in the quarter, which is pretty fair actually. And net income fell 94% to 28 million. That's concerning, of course. Now, Salesforce said revenue from its service cloud for handling customer service inquiries generated 1.76 billion in revenue, almost 17%. So it looks like their services revenue is overall going down. That's Sales Cloud as well. And so, yeah, it looks like it's getting better. Now, interesting thing here, the dot-com bubble burst nearly brought Salesforce to an end, is what the CEO said here. And in 2001, I think it really impacted us. We almost lost our businesses, and pretty much he's talking about this. And so we made a lot of changes then, and it really strengthened our business here. So, with respect to guidance, Salesforce said it sees fiscal second quarter earnings of 101 to 102 per share, and revenue from about 7.7 billion here. And they had expected 1.14, so they had expected more, and for the earnings per share, and 7.77 billion in revenue. So it looks like they actually did expect more. Did expect more, the analysts, really, from what the company is mentioning for its guidance. So they did lower their revenue guidance for 2023. And analysts polled by Refinitiv here had expected 4.65 compared to 4.74, which is a little bit better here in terms of earnings per share. So maybe that actually drove the price higher, or maybe they expected a worse outcome really. But yeah, they do expect higher earnings, and that's probably a good thing here, and that's what that's definitely a good thing. But that's probably why the Wall Street actually likes this one, and it has pretty much shot the stock up higher. Now, the P ratio of the company at 158 here is expensive. The price to free cash flow ratio at 30 is actually much better than the P ratio here, but the outstanding shares have been going up, and about 32% is what we're looking at here. That's not great, of course, because it shows that the company has been issuing shares to fund themselves with some extra money, and that's not great for stockholders, of course, who are owning the stock. So a little bit more in terms of total liabilities than I would like to have here, about 7 years of last year's free cash flow required to pay back all the total liabilities that the company has. And growth looks pretty nice over here. Revenue is growing nicely, net income, free cash flow, everything is growing pretty nicely. Now, the company doesn't have a lot of debt, as you can see, very little debt here compared to their equity, that is. And the net income margin is actually relatively low from what I would expect out of a company like Salesforce, to tell you the truth. Looks like the margins are not great here, which is a little bit surprising. Again, I mean, I would expect them to be better, like in this range over here. It looks like they're going down a little bit in the last few, maybe months or so. That's the last 12 months pretty much. That probably means that their net income has dropped significantly compared to the revenue that they are making. We'll see. Let's take a little bit of a look at the income statement first, the financial statements here. 10 billion to 26 billion, that's absolutely great growth, as you can understand. This is a massive check mark here. And net income, 127 to 1.44 billion. But remember that they did actually, if we take a look at this one, 13 billion, and they did 1.1 here in terms of net income. Now they're making 26 billion, so double the revenue, but a little bit, just a little bit more net income. This is about like what, 20% increase. So 100% increase in revenue, just 20% increase in net income. This is why the margins are suppressed. Now, balance sheet here, you will see. Remember, the company has been issuing shares like crazy. So look at these billions here because of pretty much stockholders buying new shares. And total equity 9.3 billion to 58. That's an insane increase, again funded by people willing to buy the stock. And so it's okay for the company to be getting funds from stockholders, but stockholders should be getting a good company and a cheap company for their buck. And so we're going to examine whether that's the case, of course, but it's not looking great already. Now, the operating cash flow at 6 billion over here, a lot of stock-based compensation, as you'll see, and depreciation amortization pretty much comprises all of the operating cash flow here, because it's a non-cash expense. These both things here are non-cash expenses, so they're added back to the cash flow statement. Now, capital expenditures, about 700 million here. Overall, the company, for the most part, is using some money for acquisitions and purchasing investments, which is nice to see, of course, but also selling investments in the process. Now, in terms of financing here, just getting a little bit of debt, it looks like, but still the company doesn't seem to be having too much debt. Now, the cash that they have at hand is 5.4 billion here. The free cash flow that they generated is 5.2 billion. And we noticed that this would require about 7 years of its free cash flow to pay back all the total liabilities, is what we examined earlier, which means that we're sitting at about 35 billion in total liabilities. If we examine that, we can take a little bit of a quick look. 37 billion here if you do the multiplication or division, pretty much. And this is about 7 years. This is a little bit too much, but not super concerning, especially since the company also has some cash and quite a lot of equity overall. So I'm okay with that, as long as they do not overdo it in the future. Now, the stock evaluation tool will tell us what's the price to pay, because that's the most important thing of all. The revenue of the company has been growing tremendously at about 25% every year, pretty much. That's insane. It's almost the same growth every year. This is amazing. But we'll go lower just to be safe. 12 and 14 is what I'm going to use. Net income margins. Now, this is a little bit problematic here. It seems to be decreasing, as you'll see. Last year, 5.45% over here. This is a little bit problematic for the company. Very, very variable margins here. And maybe I have to go low. Maybe let's go to 4.6. Again, this is a little bit problematic. It may be worthwhile to do multiple projections if you are green in some of these. And free cash flow margins, again, a little bit all over the place. Near 100% is what I would think is the most normal one. These ones are out of the ordinary, really. These are probably because of one-off items here, really, in the cash flow statement. So I will go with something like 80, 90, and 100 here, which is basically the same thing as saying 2%, 4%, and 6% of the revenue is what the free cash flow margin would be. It's exactly the same thing. If that was 100%, that is. Now, since this is 80%, is like saying 1.6% over here as a free cash flow margin when compared to the revenue, is what it is. Now, the annual return, 13%, and we hit calculate. And we're seeing that the company is very, very expensive. The stock price, that is extremely expensive for what it is, based on the projections that we had here. What if we go 20, 22, and 24 in terms of revenue growth, which the company has been achieving yearly, and it's not out of the question. Still, the current price is way, way more expensive than what we'd like to get it at. And even at margins that are approaching the previous years, let's just say 15%, 17%, 19% here, these are as aggressive as I could be. These are very, very confident projections, and it's only with the 19% net income margin that we are within our limits here. And the current price is actually going to be higher today, which is going to be something like, let's just find it out here. 177, so it's already red in this projection as well, I think. So this company is obviously a great company, but it's very expensive, so I would have to avoid. Looks like they are doing better, but I would need a much, much steeper decline in order to consider buying this one much, much below 100. So it's not a buy for me right now. It's very expensive, yet it was definitely very, very interesting to at least take a look at this one, see how they're doing. Thank you for watching the video. Please leave a like and subscribe if you are not a subscriber already. And I'll see you in the very next video. Bye bye.